Now, Lululemon Athletica is a designer and retailer of technical athletic apparel, especially yoga clothes for women.
It has a market cap of $7.6 billion, a PE ratio of 29.29, and pays no dividends.
Are you aware of the Lululemon brand?
I am professionally, not hands-on, which is a good thing, I'm sure.
That is a good thing.
Yeah. Look, this is a unique brand, isn't it? Very, very focused on its target market, yoga, athleisure for women, and have done incredibly well.
And a huge yoga trend. I mean, it's following a well-established and growing trend globally.
Definitely. And a hugely loyal fan base. You know, you speak to Lululemon wearers and they're fiercely loyal about the clothes and the quality and that type of thing. So they've carved out a fantastic niche, so they don't necessarily go head on head with many other competitors. As a result, they're able to command significant profit margins in a competitive space.
Now, Byron, I'm surprised that you don't hold this one at Vestact.
It's not core. We've got a few sort of side clients. We don't own it in the hot stocks portfolio. I know Paul's got a few shares himself. As Devin alludes to, best margins out of all these companies. And also, when you look at their products, they seem to be a bit ahead of the curve in terms of the materials. You know, it's amazing, stretchy materials. And this is the shirts and stuff. I've never quite used the yoga pants before.
But what we're saying is there's a lot of technology behind the fabrics that they're using.
Yeah.
And I think a lot of scope for them to grow in terms of their apparel. You know, target more men, and leverage off their brand, which is already extremely, because it's high end. It's higher end than the rest, so they can afford to charge that premium.
Let's have a look at the share price graph and see what's coming up there.
So it's been a bit of a wild ride.
So there we've got that same and quite a steep sell-off actually. Yeah,
same sell-off as the rest of them, but as you can see, a few more sell-offs than the others. A bit of a wild founder, CEO who sort of has quite a big ego and control freak. So every time he leaves, he watches over management's shoulder and then decides to come back. And
so is the CEO having that impact on the share price?
I think originally where you see sort of through 2013, 2014 and the big dip in 2014 certainly had a lot to do with that. Slowly recovering. But again, you know, the whole sector has had a pullback, and I think it's a good opportunity to get into any of these.
And it does, I mean, here you've got to look at the strategy of a niche play versus the other brands, which are all very well diversified. Yes. Why would you go for niche over diversification here?
Well, precisely because the reason they can defend their margins more, they are serving consumers that maybe aren't buying at the other brands. And once you have that loyalty, you're able to get that repeat business the whole time. The other point to note is that the company doesn't hold any debt as far as I'm aware. So it has the ability to really flex its balance sheet and expand, which it hasn't done aggressively to date. So, you know, between defending margins, loyal client base, and, you know, really...
And huge growth opportunity.
Huge growth opportunity. There's a lot going for it.
Hot or not?
I'm going to be hot on it. I think, you know, the ability to expand their brand out of the US and throughout the globe, there's certainly big appetite for it.
Devin?
Hot for me.